With its 25-year history as an e-commerce platform, Wayfair has all the hallmarks of a legacy retail powerhouse. And as a tech-forward business still led by its founders, Wayfair also has a flair for reinvention that gives it the feel of a startup. It's a heavyweight player with a scrappy attitude, or as Kate Gulliver puts it,
I sometimes describe it more as a teenager. On the one hand, you have sort of the established, leading furniture retailer. On the other hand, we are a tiny share of the overall market. And then there's whole parts of our business, like physical retail, we're just getting into stores that are brand new for us. So in many ways, it feels like, while we've established what Wayfair is, the potential is still so big that we're sort of in those, gangly years, sort of figuring out what it looks like over time.
The teenager analogy really tracks. Wayfair had a growth spurt capped by the pandemic's online retail boom. Then came what you could call an awkward phase, a stumble marked by plunging profits. Since Gulliver became CFO in late 2022, she's prioritized efficiency while setting revenue back on a positive trajectory.
When you're starting out in e-commerce, there's a significant first mover advantage. And so it is actually really important to focus on growth and gain as much share as possible. And then, in the post-pandemic period, we really shifted to a focus on profitability. And we really cleaned up the cost structure, and we got back to a place of efficiency. And now we can be focused on this, elusive maybe, but we think we're actually proving it out, profitable growth.
So the way to think about our company, we've always grown at a substantial rate, and the way we've grown at a substantial rate is really about thinking about customers, how do we take share, how do we invest in the right things. Kate's role is really that of like the senior business person helping drive it with perhaps the financial lens versus, I think in a lot of companies, more of a defensive posture.
Gulliver's role is so critical, it comes with two titles.
Tell me about the two hats that you wear as CFO and CAO. Is it really two distinct jobs?
I don't really see it as two separate jobs. They're sort of all a continuum, and each of those pieces, finance, talent, legal, corporate comms, real estate compliance, I think about them as all the back-end infrastructure that enables the rest of the business to have the customer and go-to-market focus that the business has. Come on, thank you.
Kate is someone who's incredibly hardworking, incredibly bright. She has a real knack for people. She's not afraid to have an opinion. She's also not afraid to change her opinion.
I love the sofa section over there, where you actually see all the sofas out versus sort of in Chicago, it feels like you have to go find them.
One area,
Yes.
Just as it takes a village to raise a child, Kate Gulliver understands that it takes a team to steer a company into its full maturity.
The more you can enable your team, the better you end up being at your job. First of all, everybody has to be on the same page. So it's really important that everybody understands, hey, this is the mandate. And what does that mean in terms of what targets do we have for where we're trying to get to on revenue growth? Where are we trying to get to on EBITDA growth? What kind of capital are we going to invest? And then I think it's the finance team's job to support the business in providing the information so that they're able to make great decisions within that construct.
These are not the best of times to be in the business of selling furniture and home goods. Home sales, the traditional driver of new purchases, have been stuck in a multi-year rut, and a host of factors have put downward pressure on discretionary spending.
The biggest thing to keep in mind is just the inflation that we've been suffering for the past 5 or 6 years. And at the same time, wages have not kept up the same with inflation, which will start to erode the budget that people have to spend on a larger item. What you'll hear a lot of times on earnings calls for these consumer companies is that people are being more discerning with their money, right? That's important when we think about something like furniture. It's easier for you to hold off oftentimes, especially if you're not moving homes.
Despite these headwinds, Wayfair hasn't put its growth goals on hold. It's determined to build market share even as the sector struggles.
We're not even counting on the category to come back. Our focus is on the share gain.
So you don't count on just a cyclical recovery. You've got a strategy to figure this out.
We want to keep focusing on share gain, and we think we can move the needle on top line growth from share gain this year.
If you look at our history, we've always grown at excess rates relative to the market. You're obviously aware of the macroeconomic cycle, but you're not letting it dissuade you from the concept of wanting to take share. You're taking share in the context of it.
This is a cyclical category. People need to have somewhere to sit. They need to have a bed to lay on. It will come back. Certainly you will start to see people that have been in a house for so long that they need to refresh it, or renters that are moving and need to refresh even without buying a new home. So there will be these pieces that even absent maybe rate change and the mortgage market moving better, you might see some momentum.
In the meantime, Wayfair is creating its own momentum with initiatives designed to reinforce its competitive advantages. It's building omnichannel strength with brick-and-mortar stores, adding curation to its catalog with the Wayfair Verified label, and incentivizing frequent shoppers with its Wayfair Rewards loyalty program.
Wayfair Rewards is at its core an investment in the customer. If you're a member of Wayfair Rewards, you get 5% cash back, early access to sales, better members-only pricing, free delivery on every item. These are really important things for our customer. We know they resonate with her, but they're an investment.
In the first full year of Wayfair Rewards, average revenue per customer rose more than 5%. While investments in the program have cut into margins, it's a trade-off the company considers well worthwhile.
So the way we think about it is ultimately we want to grow the profit dollars at the maximum rate and do it in a manner that over time actually will grow the margin percentage. In the short run, there's certain things that can grow the profit dollars faster that may not grow the margin percentage, because some of these things need to reach a level of scale before the percentage expands. But if the dollars are expanding very quickly in the near term, it's actually a very good economic trade. History does not show a lot of folks whose economic model is as a retailer who's won by being less efficient.
Yeah.
We want to be as lean as possible, but you don't win by not investing.
Wayfair has become leaner since Gulliver took over as CFO. She's overseen a significant reduction in operating expenses. The company has also cut about a quarter of its workforce during her tenure.
I think those are, some of the most challenging things you do as a leader and as a manager. We believe that they were the right things to do to get us into sort of the size and shape that we wanted to be at. And we actually feel quite good about where we are now. And so as we continue to get these teams in size, part of what we want to do is then how do we make everybody more efficient? And a big push for us has been how are we leveraging AI on both the front end to improve that customer experience and on the back end for our existing team members, continue to help improve sort of efficiency in our ways of working.
Customer-facing AI-powered apps help Wayfair shoppers navigate through millions of products to find items that meet their needs.
One of the tools I like to play with on the website is called the Discover tab. Basically, you can, type in what kind of room you're looking for, and it populates, AI generates an image for you, but that image is all populated with products from our catalog. You can just buy them right then.
The company is also embedding AI into many of its internal processes. No surprise, since it's been on the leading edge of technology quite literally since its inception.
We actually got our start as entrepreneurs right out of Cornell, where we were engineering students, in 1995, which is basically the beginning of the commercial internet. And so we've seen a lot of technology changes ranging from the internet to cloud to mobile. AI looks to be the potential of larger than the internet to me.
We think it's really important for all of our employees to have access to AI tools. We really want people to experiment. In the finance team, everybody has some level of access to AI technology. We've used some AI-specific tools that are being developed for finance that are helping with things like the close and, doing that in a more efficient way. I think we use it in, sometimes a little bit more creative ways around, for example, when you're thinking about an earnings call, how might something be received? What might be a back and forth? You can play with it.
Do you use it at all for, like, when you're thinking about where to put a store?
We were building with it in partnership with the real estate team, was mapping out what we call different furniture nodes around the U.S. So areas where you have a cluster of furniture stores, and that's actually very, that's something that an LLM can do quite easily.
Right.
Historically, you maybe would have used a broker to do that. We also have a third-party tool that we use that provides a lot of data around stores that is AI-enabled and that allows us to think about traffic flows and traffic patterns in and out of a shopping center, for example, to understand where, might the traffic be coming from, and then you can use, AI to sort of simulate what another store within that area might look like. It's quite fun.
Speaking of fun, up next, Kate Gulliver shows us around Wayfair's brand new flagship store in Atlanta that's designed to align digital and physical shopping in perfect harmony.
When she's here, she can have her app open, and everything that she's doing here can be very similar to what she's doing at home. And I think that consistency is quite important.
This is Bloomberg. Wayfair CFO Kate Gulliver leads the financial function at a digital-first retailer that's constantly evolving, adapting to new technologies to meet consumers wherever they are. Her undergraduate studies in political science at Yale helped prepare her for this role.
When I think about what studying political science sort of taught me, it's really how do you take large swaths of information and distill it into what actually matters. And so much of being, in a leadership position at a company that is involved in a lot of different things and moves very quickly is taking a large chunk of information and distilling that down to what really matters. So talking to folks on one team and folks on another team, connecting the dots, being able to put those pieces together. And I do think, majoring in poli-sci helps that. And I think it's given, that skill set to me.
From Yale, Gulliver's travels took her to McKinsey as a business analyst. After stepping back into academia to earn an MBA at Harvard Business School, she resumed her professional career at private investment firm Bain Capital. Her time at McKinsey and Bain taught her plenty about finance and much more.
I think what I learned at both was how important who you're working for is. And I've largely chosen roles by who I'm working for and who I'm working with. And so when I came in and started interviewing at Wayfair, what I was really taken with was how impressive the leadership team was. And I really could tell when I was talking to them how engaged they were in what they were doing and how focused on the execution they were. And that's what was so compelling for me to join the business in the first place.
Joining Wayfair as head of investor relations, leading up to the IPO, exciting time. What was that time like?
Oh, it was absolutely thrilling. I mean, it's an incredibly fun way to join a business, right? And to understand, all the different leaders at the company, to learn how Wayfair sort of saw itself, how Wayfair saw its potential.
Today, Wayfair sees immense potential in brick-and-mortar stores. In 2024, the company opened its first large format flagship in suburban Chicago. 2 more Wayfair stores have opened in 2026, and a number of future locations are in the planning stage. Like Amazon and other e-commerce peers, Wayfair is taking steps to develop a clicks-to-bricks omnichannel ecosystem.
The e-commerce platform is so lucrative because it is asset light. They don't have the overhead. So it makes sense for why companies are doing that for so long. But now, when we think about a consumer being more discerning, there is this desire to interact with your goods again, what I'm going to be buying. I want to make sure that what I'm shopping is what I'm getting. There is this desire to get back in person. We are seeing a little bit of e-commerce fatigue with a lot of people, which probably explains why companies that are digitally native for their entire existence are starting to make these investments.
CEO Neeraj Shah says that with the infrastructure Wayfair already has in place, the move into physical retail isn't a heavy lift.
If you're a national brick-and-mortar retailer, what do you have? Well, you have really nice, welcoming stores that customers like. You have a supply chain with the inventory, set up in the right place in the right quantities. You have a delivery and logistics capability when you're selling big things to deliver them to the customer. You have some sort of brand or marketing reach to let people know who you are so that they're aware of you and they come visit. Well, if you start to think about Wayfair, we actually have everything I just described other than the stores.
When we got into physical retail, our view was that, even if the market continued to grow for e-commerce, probably a large chunk of the market in the space would stay offline, right?
Kate Gulliver showed me around Wayfair's new 150,000 square foot Atlanta flagship store. She explained why Wayfair's bet on brick and mortar carries less financial risk than you might think.
One thing that's different for us than other retailers is the product that you see in the store is actually still owned by our suppliers. So they forward position the product here. It's not our inventory. And so that gives us some, flexibility. We want it to be incredible for the suppliers, of course, but it means that the cash outlay is quite different. So we think about the cash on cash returns of the store. So based on the capital investment that we are making, when do we get that payback? What does that look like? We look at the four-wall economics of the store. So the sales within the store, how does that, how's the margin looking there, the sales associate cost? And then we look at the sales that are happening outside the store that we can tie directly to the store and the overall halo effect that we think we get from the branding.
Do you have a map in your office of some sort with push pins in it and saying, here's all the places we want to be? Like, how big do you think this can be, or do you expect it to be?
We have customers all across the country. Basically, if you mapped population center and our customers, they would overlap. So most population centers are going to be good locations for us to have a store.
The goal is to create a frictionless connection between online and offline commerce, a sort of virtuous circle. It's working well so far.
When customers who have seen us online come into the store, they're generally a bit surprised by actually the breadth of what we offer. Often if you're going online, maybe you're looking for something particular. But when you come into the store, you walk in, you see, the market square, you see all these pillows, you see the decorative accents. So what we're seeing actually is that in store, we do really well in some categories that online are, less a percentage of the total.
How does technology help in kind of making it seamless online to store?
I think
and vice versa.
The biggest thing is for the customer on the front end, that she can be in the store, that she can actually shop here, go back home, complete that purchase. And if you look at these sort of price tags and everything, they're all these digital tags. That's because they're the exact same prices they are online. So you're not going to be surprised that you saw something in the store and then you decided to purchase it online, that it's somehow different and that the offering is different. It's actually very consistent. But when she's here, she can have her app open and everything that she's doing here can be very similar to what she's doing at home. And I think that consistency is quite important.
Of course, stores also allow shoppers to interact with Wayfair products directly with an immediacy you just can't duplicate on a laptop.
This is one of my favorite parts of the store. Shopping should be fun. It's an experience, and this is the shower wall, and you can see how the shower works.
So you can actually play with these things. And
what does it look like when it comes out? It's mostly for fun. I mean, you can see how beautiful all of these are, but it adds an interactive element.
Well, you and I've talked about the importance of social media in this space.
Yes.
And I think about, is this like an Instagrammable moment?
This is not why it was built, but it totally works for that because it's unique. I mean, where else can you go and actually test it out on the shower wall? There's very few other places, I think, if any, that you can do it. We actually started this in our Chicago store, and I will say as a CFO, you see running water in the middle of the store and you think, is that going to be a great investment?
Yeah, exactly.
But it is so fun and it's so engaging that it really helps bring the experience together.
Coming up, Kate Gulliver on the hardest part of being CFO and making just the right call when there's risk involved.
Someone has to make that risk decision and has to own that wherever it pans out.
This is Bloomberg. How do you build a $12 billion global furniture retail powerhouse? In Wayfair's case, it's by selling products from thousands of suppliers around the world, supporting them with a technology platform and fulfillment network that helps customers find what they want and get it quickly. So far, this model has helped the company weather tariff turmoil and geopolitical shocks that are hitting retailers hard.
If you take a long-term lens, there's always something changing in the market. There could be ocean freight congestion, there could be supply shortages, there could be different geopolitical events, different countries could have different policies in place. We don't view those things as really hindrances. Like the world's always changing. We have a very large and diverse supplier base that helps us. Offering that depth and breadth to customers helps customers have choice. Our suppliers know they have to compete with each other to offer the customers value. Certain companies take a strategy of wanting to pick a specific strategy that's narrow, and then they could either win or lose if that's correct or incorrect. The platform model we've had, it's really proven to be very resilient, and not just in like the recent time frame, but it's kind of done that over a long period of time because of sort of the depth and breadth of it.
The lion's share of Wayfair's revenue currently comes from sales in the U.S., but it sees opportunity to grow in other countries where it already has a promising foothold.
We have operations in Canada, the UK, and Ireland. Those are markets that are doing really well for us, but I wouldn't say that they're mature markets. Okay. We see a lot of potential there, and we're already established there, and we can operate them, sort of largely from the bases that we've, already created. Build off of that. Yes, easier to build. And, things like stores we don't have in those markets yet. We would love to at some point. I do think it's an important part, of the overall story. That said, our focus is let's get the stores working the way that we want them here, and then over time, we'll move them into those markets.
Kate Gulliver's management of Wayfair's balance sheet has lightened the company's debt burden while freeing up resources to put back into future growth.
Kate's done an incredible job. If you look at the convertible debt tranches we had out there, we're effectively at this point almost free and clear of all of them through a lot of the work over the last few years of paying them down with cash, refinancing them into non-dilutive debt instruments with much more staggered maturities. We've been able to leverage our free cash flow to basically reduce dilution, and while ramping free cash flow, still investing in the business. We're actually investing for growth in a way that's generating more cash.
So a few years ago, we really started focusing on how do we move beyond our convertible debt instruments, which are dilutive, and how do we bring down the gross leverage overall. And sitting here now, we're quite pleased actually with the progress that we've made. Our leverage ratios have improved dramatically. Then we've actually moved past most of our convertible notes. Our goal going forward is how do we continue to manage the overall leverage? We want to continue to improve that leverage ratio, but now focus on dilution.
Never issued a dividend or had a formal buyback program. Could that eventually be something?
So a formal buyback program, could eventually be a piece of dilution management. So far, we've done dilution management by buying back the convertible notes. Those are in the money, so they effectively act as an equity instrument. But going forward, you can imagine, doing that through more of a formal program.
That sums up Kate Gulliver's role as CFO of Wayfair, imagining ways to help the company reach its potential, using every financial and operational tool at her disposal. I asked her what she sees when she looks ahead.
Kate, what's the opportunity for Wayfair in the next decade that most excites you?
Oh, it's stores. It's physical retail. I mean, we're sitting in one, so clearly we love it. It is pretty wild to be almost 25 years into the business, right? The company's been around 25 years and be launching an entirely new channel. And when I think about the potential of that channel, it is thrilling.
Flip side, what's the challenge for Wayfair in the next decade that kind of keeps you up at night?
I actually think it's one and the same. It is also physical retail, and I'll sort of explain why. We are building a muscle that we have not built yet. And that includes, as you ramp up stores, hiring great store managers, hiring a great store team, ensuring that the technology in the store is working well, ensuring that the logistics infrastructure that powers the stores and the rest of our e-commerce is working well. And so we're adding on this new channel that we're really excited about the potential of, and that will require some new skill sets that we haven't yet built. And we'll need to sort of develop that muscle, and we're building it out well now. That's why we've taken this iterative approach, but it will be a challenge, and I'm excited for it.
All right, complete the sentence. The hardest part of being a CFO is?
I would say it's the constant sort of risk refinement. Great startup CEOs have a really great appetite for risk, but you learn to calibrate and adjust that appropriately. And a great CFO partnering, particularly with a startup founder, should be able to help with that risk calibration. And it's really one of the few things that as the CFO, at the end of the day, you have to make the call on most of those things, and you wear that call. So many of the other things are sort of team exercises and team disciplines, but this is something where, in many situations, someone has to make that risk decision and has to own that wherever it pans out. And I think, you're sort of constantly calibrating to make sure that you're allowing the business to move forward, you're allowing the business to be nimble, but you're not putting undue risk on the company.
All right, so a friend calls you up and says, I've got great news. I just got promoted to CFO. You say congratulations, of course. What's the first piece of advice that you give this person?
Gosh, I would tell them to make sure they have a phenomenal team. In particular, that they have an excellent controller. That is a key to success. But I think having a great team below you is the most, that you're partnered with, is the most important thing for the CFO. And a great working relationship with your CEO. That's make or break.
I'm Carol Masser. This is Bloomberg.